morning, investors, and welcome to your Stock Sense morning brief for Thursday, December 4th, 2025. I'm Malik, and yesterday, the Pakistan Stock Exchange took a sharp turn, snapping a 4-day winning streak with a significant dip. Let's get you up to speed on what moved the market and what to watch for today. The KSE 100 index experienced a notable downturn yesterday, shedding nearly 1,500 points to close at 166,145. This represented a decline of 0.9%, a much sharper drop compared to Tuesday's modest dip of just over 400 points, or about 0.25%. Market activity surged, with traded volume almost doubling to nearly 593 million shares, up from around 292 million on Tuesday. The total traded value also saw a substantial increase, reaching over 44.4 billion rupees. Market breadth was decisively negative, with 291 decliners significantly outpacing 136 advancers and 46 scripts remaining unchanged. This clearly indicates broad-based profit-taking after the recent upward momentum. Diving into sector performance, commercial banks and the fertilizer sector exerted the strongest downward pressure on the index, contributing significantly to the day's losses. However, it wasn't all red. Investment banks, investment companies, and securities companies provided some positive momentum, helping to partially cushion the broader market's decline. From a technical standpoint, the KSE 100 presents a nuanced picture. While longer-term indicators, such as the 50-day and 100-day exponential moving averages, continue to signal buy, suggesting underlying strength, some shorter-term indicators are now flashing selling pressure. Key pivot points show initial support around 160,250, with resistance expected near the 170,000 mark. The central pivot point for the day stands at approximately 163,600. On the corporate calendar today, December 4th, 2 board meetings are on our radar. Bershine LPG Pakistan Limited will be reviewing its first quarterly accounts for the period ended September 30th, 2025. Additionally, Samba Bank Limited has a board meeting scheduled to consider matters other than financial results. Importantly, there are no companies hitting their last day of entitlement for distributions today, so no immediate deadlines for investors on that front. Turning to the broader economic landscape, we have a mixed bag of news influencing investor sentiment. A major positive comes from the government's announcement that the bidding for Pakistan International Airlines, or PIA, will be held on December 23rd with a live media broadcast. This is a monumental step, marking Pakistan's first major privatization in almost 2 decades, signaling a strong commitment to economic reforms and boosting overall investor confidence. However, on a more challenging note, merchandise exports continued their concerning downward trend for the 4th consecutive month in November, dipping by 15.4% year-on-year. This contributed to a significant 33% rise in the trade deficit, highlighting persistent challenges in global demand and the cost of doing business domestically. A World Bank economist further emphasized this, warning that Pakistani companies need rapid compliance with international standards to safeguard exports, pointing to a critical structural issue. Despite these export challenges, proactive efforts are underway. The Prime Minister has reiterated the government's commitment to practical measures for export-led economic growth. Furthermore, the Pakistan Fruit and Vegetable Exporters Association has finalized an ambitious plan to boost their exports to $2 billion within the next 3 years, a substantial jump from $700 million, indicating targeted initiatives within key agricultural segments. In positive energy sector news, Pakistan and Turkey have signed 5 memorandums of understanding for oil and gas exploration, mining, and power sector cooperation. This significant collaboration could unlock substantial foreign investment and activity in these vital sectors, with Turkish Petroleum even planning to establish an office in Islamabad this month. Conversely, the local automotive industry has voiced strong concerns over the alleged misuse of import schemes. They claim this is severely impacting domestic production, with local vehicle manufacturing dropping significantly from 325,000 units to between 150,000 and 170,000 units. This presents a considerable challenge for listed auto sector companies. Finally, in industrial news, domestic cement sales saw a slight uptick of 2.2% year-on-year. However, exports fell sharply by over 26%, primarily due to border closures with Afghanistan. On the flip side, urea sales surged by 25% year-on-year to 817,000 tons, indicating improved agricultural activity, possibly aided by manufacturer discounts. This paints a mixed picture for industrial performance. Let's look at the institutional flows for yesterday, December 3rd. We observed a dynamic interplay between different investor categories. Foreign institutions were net buyers, injecting approximately $2.4 million into the market. Conversely, local institutions were net sellers by roughly the same amount, indicating an overall balance in institutional capital movement. Delving deeper into the local market, individual investors showed strong buying interest, with net buying of nearly $19.5 million. This strong inflow was largely offset by significant selling from insurance companies, which pulled out almost $29.5 million. Banks and DFIs were also net buyers, adding about $5.5 million. Mutual funds and foreign corporates, however, were on the selling side, though their net outflows were relatively small, at less than $1 million each. My take on yesterday's market action is that we witnessed a classic tug-of-war. The sharp fall was largely a consequence of profit-taking after a decent rally, amplified by concerning macroeconomic data like the persistent dip in exports and the challenges facing our auto sector. These factors certainly weighed on sentiment. However, the market didn't completely capitulate. This resilience can be attributed to underlying optimism surrounding key structural reforms, notably the privatization of PIA and new foreign investment pledges in the energy sector with Turkey. It's particularly interesting to see individuals showing strong confidence by buying the dips, while larger local players, specifically insurance companies, appear to be locking in profits. This divergence suggests a cautious optimism among retail investors, perhaps betting on longer-term recovery and reforms versus institutional rebalancing. The coming days will be crucial as investors continue to weigh these significant structural positives against the immediate economic headwinds and the ongoing tug-of-war between buyer and seller sentiment. That wraps up your Stock Sense morning brief for today. Remember to stay informed and make well-researched decisions. Join us again tomorrow for another update. Until then, invest wisely.